The crypto market is getting hot, and you know what that means. Mistakes. Lots of mistakes. There's a reason why buying the top and selling the dip is a meme. When the gains are big enough, even the most hardcore hodler starts to feel the heat. 50%, 100%, 10,000% in a day. When do you buy? When do you sell? Is it a pump and dump or a one-way ticket to financial freedom? Figuring this stuff out is hard, but there is a solution, and it starts with recognizing what you're doing wrong. So today, I'm going to tell you about some of the most common mistakes cryptocurrency traders make so you can turn that wrecked into riches. Before we hit the trading floor, there's something you can't ignore. I am not a financial advisor, so if you came here looking for financial advice, I'm afraid you won't find any. If you look closely, you'll see that I am just an educator and entertainer who has been consumed by crypto. My name is Guy, and if you're new here, then I'd like to welcome you to the Coin Bureau Basecamp. In my crypto videos, quality comes first, hype comes second, and sometimes not at all. Coins, tokens, DeFi protocols, market analysis, exchanges, NFTs, the list is endless. So, if you're sick of 100x Moonboys and want some meaningful knowledge that doesn't expire when the pump gets tired, subscribe to the channel and ping that notification bell. While you're down there, take a moment to skim across the timestamps I've left in the video timeline. If you see something that catches your eye, you can skip ahead, but be warned, I might cry. In all seriousness though, it helps the channel grow if you watch the whole way through. So, without further ado, let's see all the trading things you shouldn't do. The number one mistake cryptocurrency traders make is going in without a well-defined plan. Before you've deposited even a single sat into a cryptocurrency exchange, you have to ask yourself if you're playing the long game or the short game. Now, just so we're on the same page, long-term means months or years, and short-term means days or weeks. If you're in it for the long haul, you should know that buying and holding will be about as profitable as day trading. This is thanks to a popular strategy employed by hodlers called dollar cost averaging, which is where you purchase a cryptocurrency at regular intervals regardless of its current price. Multiple people have run statistical models comparing dollar cost averaging to buying the dip, and in just about every case, dollar cost averaging has been found to be a more profitable investment strategy in the long term. This is primarily because there is no way of knowing for sure where the bottom of a dip is, and it's unlikely that you'll buy the bottom of the dip every time over and over. If you have somehow figured this out though, be sure to give me a call. If you're trying to make a quick 10x return within a matter of days or weeks, be prepared to be glued to the charts 24/7 because the crypto market never sleeps, and neither will you. Being familiar with technical analysis will consequently be extremely important, and I happen to have a few videos that teach you the basics that I'll leave in the video description. There's something else you should know too. Not to be a negative Nelly, but the fact of the matter is that short-term gains of 10x or more are much harder to find at this stage in the bull market and will only become rarer as time goes on. This means that you'll have to venture further and further out to the fringes of the altcoin space to find promising candidates for your mission to the moon. To ensure you don't get rug pulled, scammed, or dumped on, you'll have to do your own research on these projects and also stay up to date with what they're doing. Pro tip, you can join their Telegram channels and enable notifications when you follow them on Twitter. If you want a guide on how to find a promising low-cap cryptocurrency, I happen to have one, and you can find it up there in the top right. Besides the absence of a trading strategy, the other thing that traders often lack is a solid exit strategy. Now, the term exit strategy can have a different meaning depending on who you ask. For many, exit strategy means the point at which you convert your cryptocurrency gains into fiat. For cryptomaniacs like me, exit strategy means converting my altcoin gains and fiat into Bitcoin. While it is up to you to decide how you manage your personal finances, allow me to briefly make the case for Bitcoin in a single sentence. Whether you want to buy a house, a car, some stocks, or even precious metals with your crypto gains, chances are that in 5 years' time, those assets will be worth much less than what you would have if those profits had been allocated to BTC instead. That said, you can't live inside a Bitcoin or drive it around, and both of these things require fiat currency to purchase. Tesla cars, of course, notwithstanding. This means you will probably want or need to withdraw cash from your crypto positions at some point. There are two ways you can do this: all at once or over time. The advantage to withdrawing all at once is that it will make taxes a bit easier to manage, and you'll also hopefully be sitting on a fairly substantial amount of money. The disadvantage is that, like buying the dip, there is no way of knowing for certain that you sold at or near the top until much later. This could leave you feeling some serious FOMO if prices continue to rise, and this could do a number on your ability to think critically. This could cause you to FOMO back in, as I'm sure many of you have done in the past when you cashed out all at once from a cryptocurrency you were holding. If you have a long-term vision, you might be happy enough to take those profits and walk away when the day to cash out comes around. Alternatively, you could use an exit strategy that works well regardless of the time frame, and that's to take profits at fixed intervals. This is a similar idea to dollar cost averaging, but instead of using time as the interval, you're using profits in dollars or percentages as the benchmark. For example, you could have a profit-taking strategy where you sell 20% of a cryptocurrency you're holding every time it doubles or triples in price. Yes, the profits won't be as large as if you'd sold the top, but they will be much more predictable, and you'll get a better estimate of how much you'll have in the end. Most importantly, you'll have enough cash on hand to buy the dip if you're day trading, or add back to your crypto positions if you're dollar cost averaging. If you insist on taking the YOLO route and cashing out all at once, I recommend using my video about how to plan your ultimate altcoin exit strategy using the link in the top right. Another common mistake cryptocurrency traders make is not paying enough attention to order book depth. My suspicion is that this is because most crypto traders don't know what it is, how to check it, and why it is important in the context of trading. If you click on the Depth tab of a trading terminal on an exchange like Binance, you'll see the order book depth for that trading pair. This is essentially a representation of the buy and sell orders for that cryptocurrency pair on that exchange. If you see a depth chart where the buy wave is larger than the sell wave, this suggests that there is not much demand for the cryptocurrency being traded. The steps you often see in the sell wave are called sell walls. Sell walls mark a price where a lot of traders will be selling. The larger the sell wall, the harder it will be to push past that price point. Sell walls are usually found at psychologically comfortable prices like 50k or 60k, but can sometimes be clustered around more arbitrary figures. More importantly, sometimes the resistance you see in the depth chart is not all that obvious when you're just referencing previous price action on the regular price chart. Referencing the price chart alone means you could accidentally be selling too early or too late when prices start to move up. Conversely, a depth chart where the buy order wave is significantly larger than the sell order wave usually means there is a lot of demand for that cryptocurrency. Logically, the steps you see in the buy wave are called buy walls, and these tend to mark zones of support because a lot of people have set orders to buy in when the price dips to that level. Again, sometimes the strong support you see in the depth chart doesn't perfectly match up with what you see on the price chart, which could mess up your plan to buy the dip. On Binance, the order book depth chart is zoomed all the way out by default, meaning you can actually zoom in to get a closer look at the immediate zones of buying support and selling resistance. This is useful if you're trading on a time frame that's shorter than a day. Pro tip: if the depth chart feels a bit too arbitrary or chaotic, you can use the Markets tab on CoinGecko to see the order book depth for the cryptocurrency you're craving. If you notice that it takes a lot more money to push up the price of a crypto by 2% than it does to push it down by 2%, you might want to consider finding another crypto to trade with in the short term. Similarly to order book depth, I find that other macro metrics like trading volume and circulating supply are also frequently overlooked by crypto traders. Now, to clarify, I'm not talking about the trading volume you see on trading terminals on cryptocurrency exchanges, but the trading volume you see on sites like CoinMarketCap and CoinGecko. These give you a bird's eye view of the trading volume for that cryptocurrency across all exchanges, and also lets you easily spot any volume abnormalities which could suggest price manipulation. A cryptocurrency should have ample trading volume relative to its market cap, and ideally, that trading volume should be high on more than one exchange. This is especially true when it comes to up-and-coming ERC20 tokens, which often trade exclusively on decentralized exchanges like Uniswap. As a general rule of thumb, if you see a cryptocurrency that's trading primarily on a DEX, be sure to give it some extra due diligence during your research. Also, be on the lookout for any ridiculous trading volumes taking place on lesser-known exchanges, which is common for many projects that trade primarily on Uniswap. These fake volumes can sometimes inflate the trading volume reported by CoinMarketCap and CoinGecko. Pro tip: you can use Uniswap's free analytics to get a more in-depth look at the trading history of ERC20 tokens on its DEX. When it comes to circulating supply, this is something that can again be easily checked with CoinMarketCap via the grey bars you see next to each cryptocurrency. If there's no grey bar, either the entire supply is in circulation or CoinMarketCap doesn't have access to that cryptocurrency's blockchain data. Circulating supply is important because a low circulating supply relative to the total or maximum supply means that there could be a risk you'll get dumped on by early investors or the team behind the project. This is why it's extremely important to check what the vesting schedules are like for coins or tokens allocated to the team, early investors, advisors, and any other parties that could start selling. You can usually find these vesting schedules in a project's white paper, documentation, or their ICO details on ICO drops. To show you just how important circulating supply can be for trading, consider Theta and Chainlink. Both have valuable use cases. The former is a decentralized video streaming platform, and the latter is a data oracle which is crucial to the operation of just about every cryptocurrency dApp. Both Theta and Link have a maximum supply of 1 billion. The difference is that 100% of Theta's supply is in circulation, and most of that supply is in the hands of regular Theta investors. By contrast, only about 42% of Link is in circulation, and the team has been actively selling Link on the open market since last summer. Now, before the Link Marines call for my head, I know that the Chainlink team is using these funds to onboard more projects, foster new partnerships, and supercharge the development of their Oracle services. I discussed this at length in my last video about Chainlink, which I'm sure most Link Marines saw. As I also mentioned in that video, the initiatives being funded by these Link sales will likely mean incredible growth for Chainlink in the long run. However, it doesn't change the economic reality in the short term. A flood of supply without a corresponding increase in demand leads to a suppression of price action. I suspect that this is why Link is only up around 50% since last summer, whereas Theta is up by more than 25x despite the fact that Theta's community is only a fraction of the size of Chainlink's. That is the power of circulating supply. Theta seems to have reached its top for the time being though, and this is because of another factor often overlooked by cryptocurrency traders. That's a cryptocurrency's market cap. The larger the market cap of a cryptocurrency, the more money it will take to push its price up. For example, right now it would take up to $70 million to push up the price of Bitcoin by just 2% on one exchange. If we took that same $70 million and used it to buy Injective Protocol on Binance, it would probably wipe out the sell orders in the order book and push up the price by 50x or more. This is why you have to go looking for lesser known altcoins if you want to pull a quick 10x. Altcoins that you find on the 5th or 6th pages of CoinMarketCap and CoinGecko tend to have very low market caps, meaning it takes much less capital to push up their price. This also means that it takes much less capital to push down the price, so keep that in mind. Here's a more salient example to really drive the point home about market cap. As some of you will know, Polkadot is a smart contract blockchain that is a competitor to Ethereum and is currently in the process of rolling out its parachains, which will host its various dApps and smart contracts. Before Polkadot plugs in its parachains, it will be testing the parachain auction process on its standalone testnet, Kusama. Now, Kusama is basically a carbon copy of Polkadot and also exists as its own cryptocurrency network with its own native KSM coin. Polkadot has a massive market cap of over $30 billion, whereas Kusama's stands at around $4.5 billion at the time of shooting. KSM has gone up by nearly 10x since the start of the year, whereas DOT has only gone up by about 3x. This is because you have billions of dollars coming from the Polkadot ecosystem to engage with all the Polkadot projects that are first launching on Kusama. Because Kusama has a much smaller market cap relative to Polkadot, it doesn't take very much capital to push up its price. KSM has been on a tear as a result, and the parachain slot auctions haven't even started yet. I suspect that Kusama has more growth on the horizon, and you can get my in-depth analysis of that by watching the video up in the top right. The last trading mistake that I want to discuss is one that I find myself making a lot these days, and that's investing in a cryptocurrency project just because you expect the price to go up for whatever reason. In my experience, having expectations is the number one killer of crypto gains. Expectations come in all shapes and sizes, and the one you're probably all familiar with is the expectation you feel when the price of a cryptocurrency starts to skyrocket. As soon as you see that thick green candle, you think, yes, this is it, I'm finally going to be a millionaire. If the feeling is strong enough, you might even go as far as opening a leveraged position on a futures exchange and cranking that meter up to 100x with no stop loss, and then get wrecked when the price dips. On that note, if you absolutely insist on trading with leverage, I recommend you stick to leveraged tokens. These have limited downside risk and they don't tempt you to crank up leverage that risks your capital. I covered leveraged tokens in my third technical analysis video. Feel free to pop open a new tab by hitting that link in the top right so you can come back to it after this one. Anyways, where do these unrealistic expectations come from? Well, the short answer is that they come from other people. The crypto news, crypto influencers, and even crypto projects will draw attention to their own or other projects. Even when people with influence aren't trying to pump the coin or token they're talking about, it usually does just that. Now, to be honest, sometimes when I review a coin or a token, the price does actually go up right after release, something that many of you have pointed out in the comments section. This is why I stay away from microcap altcoins and always let you know if I hold the cryptocurrency I'll be talking about at the start of every video. Still, my videos play a part in driving unrealistic expectations because they make people think that whenever I drop a video, the price of that cryptocurrency I'm talking about will automatically go up, which doesn't always happen. The same is true whenever another large crypto YouTuber makes a video about a coin or token, or when Cointelegraph or Decrypt put up an article detailing some exciting announcement about a cryptocurrency project. More often than not, people will FOMO in the first few minutes expecting a price pump, and maybe it does pump by a few percentage points. It feeds on itself as those who see the pump try to catch it themselves, and so on. Then a whale sees an opportunity and comes by to dump on those investors, leaving them wondering why they bought that cryptocurrency in the first place. Instead of banking on a boost from some bullish news, take a moment to ask yourself if the cryptocurrency you're investing in has some fundamental value that makes it worth trading or holding. If it doesn't, then it's probably a waste of your time, even in the short term. Here is a useful phrase to remember. Strong cryptocurrency projects do not need shilling to succeed. Figure out your trading strategy, plan your exit, do your research, practice your technical analysis, try dollar cost averaging. Take profits every now and then. Pay attention to order book depth, circulating supply, trading volume, market cap. Ignore the hype and hopium and focus on the bottom line of real-world value and utility. All the resources you need are right here on this channel. If you enjoyed today's video, smash that like button and be sure to subscribe to the channel and ping that notification bell so you don't miss tomorrow's video. If you're addicted to social media, well, you can follow me on Twitter, Instagram, and TikTok to get your fill of crypto facts, memes, and take a sneak peek behind the scenes. Keeping up with the crypto market is hard, but you don't have to do it alone. You can join my Coin Bureau Insider Telegram channel to stay in the loop on all the latest and greatest crypto coins, tokens, and trends. If you want to know what cryptocurrencies I hold as part of my portfolio, well, you'll have to subscribe to my weekly newsletter. In addition to my portfolio, you'll get a mountain of valuable information and resources you can use to level up your career as a crypto connoisseur. If you want to support the channel, you can do that while looking stylish by picking up a few items from the Coin Bureau merch store. You'll find the links to all these tricks and treats tucked in the video description. Well, that's all for now, folks. I'll see you very soon. Sayonara.